Welcome to Stock Market Investing with the ARMR Report. This is the morning call. Thanks for joining us, morning insiders. For those of you who are there getting ready for the start. All right, it's Fed Day. So number one thing on Fed Day I would share with you is that I generally don't trade at all on Fed Day. See, my job every morning, every day, every time I touch that entry button to buy or sell something, in my mind, is to get myself on the right side of probability and statistics. And you all can say this with me in chorus: when reward is worth the risk. So on Fed Day, there are so many head shakes, so many head fakes, that the probabilities that I'm going to get some type of outsized move on the upside, which is the reward figure, in front of the Fed news is limited, right? And the head fakes are constant. So I generally just don't trade, okay? And if you're part of the live trading desk the last few weeks, you could see, if you go back and look at our days when we're making money, it's very clear. It's because the market is ripping higher. We put day trades on, make money. 7 out of 10 stocks follow the market. That's just a fact. 8 out of 10 follow the group. This is how money is run. So our job is to get on the right side of those trends when we're putting trades on individual stocks and not fight those trends. You know, I say all the time, get on the right side of probability, but what does it really mean? I mean, obviously algorithms help us do that, but you don't have access to your own personal algorithms. You work with me and I share with you mine. So what steps can you take as an individual to get on the right side of probability? Well, first of all, make sure you're in the right trend of the market. Don't fight the market trend. And second of all, make sure you're not fighting the group action. So you can go look at a chart that you love and say, oh, this stock looks great. Go find the ETF that, if there is one, that mirrors that group. If the whole group looks awful, you might want to think about that trade, because you'll be fighting an overall group that doesn't look right. Example, there might be 1 or 2 cannabis names that look good, but the whole group looks terrible. So I'm not putting money to work until that picture changes, okay? When it comes to cannabis, real quick, we can take a look at, I'm just kind of all over the place right now. We'll look at the index real quick first. This is the S&P. You know, don't forget we're in this long-term uptrend. We haven't looked at this in a while. And the market's just crawling up, you know, this channel right here. We would love to get past Fed Day with a big spike higher as it runs to the top of this channel and touches the original uptrend line. Who knows that that's going to happen? I mean, this could be a double top breakdown or who knows what, okay? We just have to read and react to what the market's giving us. But I was looking at the cannabis stocks this morning. So we broke below the 40 level on MSOS and recaptured it yesterday, which is great, right? But it is a lower low and it's still lower highs. So that's really just still a downtrend. But let's say we did this, and we drew a parallel line to the bottom of the trend. I think what you'll see this time, this is the first positive piece of news for me, right? We didn't make a new low here. We didn't touch the bottom of that trend line, right? And so that's positive. The buyers came in a nice median bar reversal action right here. It's not textbook median bar, but it's close enough for me. And now we're back above 40, so that's great. And so that makes me want to look at the top 4 names in the space. And if they start looking good and I want to put some positions on, I'll start there. Then I'll broaden out. But because of the illiquid nature of the market of these stocks, if we're in a tricky market, if we're in a market that's, you know, prone to air pockets lower, but the last thing we want to do is be in a bunch of illiquid stocks trading on the Canadian Stock Exchange. So this is why I'm kind of waiting for more. This is step 1 on the cannabis stocks for the US. Step 1, they did it. They did step 1. They didn't touch the bottom of the channel. They had a median bar reversal and popped it back above the 40. That's step 1. Now what I'd like to see is a higher, you know, break this downtrend completely. I mean, here we are, you know, and trends have to be broken for 3 days or more than 3%. So get above that line and stay there for more than 3 days, or go up more than 3% above that line, right? That'll be step 2. Then it'll pull back at some point and test and start making a higher low. That'll be step 3. And that next move higher, step 4, is what I'll end up buying. Okay. But to wrap up my thoughts this morning, I'm not doing anything today unless it's really essentially necessary. Microsoft, Facebook, they each had announcements of earnings that, whatever. They both looked fine to me. One's up 2%, one's down 2%. It doesn't really matter. We're following the ARMR investing way, which is to say we put those positions on early. We booked some profits right near the tops. Now we just let them play out. We have rising trailed stops in both of these positions. I don't know how much money I'm going to make on this. The 50-day moving average is my stop. If it keeps going up, I'm going to stay with it. Okay, right? Same thing with Microsoft. The 50-day moving average is clearly the stop. It continues to go up, we stay with it. That's how I'm trying. Now, if it comes back down to the 50, reverses, gives another opportunity, I might put the position back on that I sold. Right? So there's different ways to trade it. Also, Teledyne had a good earnings number. That stock looks to, I don't know if it's going to be up or not. It doesn't look like it's got a real bid or offer yet. Let's see. 350. No, there's no real bid or offer there. So I don't know what that's going to do. But it looks like a good number. Okay, so we'll let it just play out. Now let's talk about Pinterest right quick. Okay, we do not own Pinterest in the portfolio. We got stopped out right here on this big down day, and it felt ugly and it felt uncomfortable, and what a bummer. We bought it here, it looked great, and then it failed. All right, the reason we have stop losses is to avoid the 12% decline in the stock this morning, or 11 and change. Okay, it's going to take the stock back down to 68 and change, which is going to test these lows. Okay, I'm going to listen to that earnings call. I haven't listened to it yet. I'm curious what they're going to say. Probably just some shenanigans, Wall Street not liking something ridiculous. But this is why I use stops. No matter how much I like this name, it just didn't set up right. This is also why I've shifted to ETFs, right? If the number was great and the stock was up huge, guess what? We own ARKK, right? And it owns a piece of Pinterest. It owns a piece of Spotify, right? If Spotify had a great number, that would have been fun too. But Spotify's down on the news. Where's Spotify trading now? On its earnings news, and Pinterest is selling off. So we're probably going to see some weakness in, Spotify is getting whacked. 270 down from 292. Okay, so this is why I'm trying to shift our attention to index ETFs at the moment, group ETFs. I want to lower our volatility, but still have some exposure. A couple of blow-ups over here, what looked like decent chart patterns, companies that we love, but the action wasn't wholesome, and it didn't set up for me, and so I wouldn't put those trades on in front of the earnings numbers, and now the stocks are getting whacked. So we have a small position on ARKK. There's some bad news out there on a couple of these names. Let them come down. That'll give us a chance to build our exposure to ARKK, because ultimately I think the market's going higher and these stocks will recover. Okay, but looking at what's going on in we're really not getting paid on good earnings. Good earnings are only putting the stock up a couple percent, and anything that's considered a miss is dropping the stock 10% or more. The reward to risk is not right. So I'm going to hold Teledyne, Microsoft, Facebook, because the volatility there is different. But I'm not going to be holding some of these smaller, more aggressive names into earnings, because it's just not worth it. It's not paying. It paid last year. It's not paying this year. And that's why I'm trying to shift our focus into group ETFs.